Hi, this is Robert Wright. One thing I like about the conversations I have here on The Wright Show is that they help me think and write. They've informed the books and many of the articles I've written over the past 15 years. Now, lately, most of my writing has been for my newsletter, the Nonzero newsletter. It covers the kinds of topics you see on the show: politics, foreign policy, psychology, philosophy, spirituality, how to avoid the apocalypse, things like that. So if you enjoy The Wright Show, chances are pretty good that you'll enjoy the newsletter. It's free, and all you have to do to get it is go to nonzero.org and sign up. So I suggest that you hit pause, go sign up, and then hit play. Thanks. Hi, Richard.
Hi, Bob.
How you doing?
Very well.
Let me introduce us. I'm Robert Wright. This is The Wright Show, available on both streaming video and via audio podcast. You are Richard Vague. You've been with us a few times, actually. We've talked about a couple of your books. One of them, A Brief History of Doom, 200 Years of Financial Crises. Before that, we talked about your book, The Next Economic Disaster, Why It's Coming and How to Avoid It. People may already be guessing why I want to talk to you right now, because a lot of us would like to know if we're on the precipice of another economic disaster that will usher in an era of doom. And that's what we're going to talk about. I should add that you have a long history in the banking business. You co-founded and ran a couple of credit card companies. I think at one point your company was the largest issuer of Visa cards in the known universe. You're a venture capitalist now, managing partner in Gabriel Investments, and you have a number of other roles you can either mention or not as you see fit. Is this enough? You do publish Delancey Place, the newsletter that people should sign up for. Long-standing. It's venerable, I would say, right?
Venerable.
It every day brings people a reading, a selection from an interesting book, and
such as Nonzero.
Such as Nonzero in the distant past. Oh my gosh, who wrote that? That was 20 years ago. Let's don't go there.
What, was it only 20 years ago?
Yeah, it seems like. It's funny how a pandemic stretches time out. I want to. Before we get started, let me ask about that. How are you faring? Now, you're in Philadelphia, which has fared better than, say, New York amid the pandemic, right?
It's been tough in Pennsylvania generally, and we're getting along. Okay, well, why don't we start out by reviewing how we got to the current economic moment? So the pandemic, the initial economic news from the pandemic was what is called a supply shock, kind of. China's factories closed. I think in retrospect, that was far from being the biggest shock delivered to the system, right? Because the next thing was that when we started closing economies partly down in the United States and Europe, elsewhere, we got what's called a demand shock. Suddenly people weren't buying things they used to buy. In response to that, the government has stepped in and is injecting money in one way or another into the economy, and I think what may be a completely unprecedented scale. You can tell us whether it is or not, but in any event, that in itself has brought a new set of concerns, as to how long that can be continued without having its own negative consequences and so on. So we're in a period of massive economic uncertainty. And I think anxiety. So far, does that seem accurate to you? That's reasonably accurate, Bob.
Okay.
Well done.
Thank you. Now, what is the thing, and I should add that, one thing you've written about and focused on in the two books we talked about is the role of debt and excessive debt in ushering in bad economic times, which is a concern right now. Again, people are wondering, is the government incurring too much debt? So you'll have a special kind of expertise to bring to bear on that. But
why don't we just, I just want to start by asking you, what are you most worried about right now?
The collapse in GDP. And, GDP, if you think about it in its simplest terms, is just spending. So if our GDP was 21 trillion, that means there was 21 trillion in spending annually in the United States. And that is collapsing because people are staying at home and aren't able to get out and spend. And, some economists have estimated that in this quarter, that collapse could be as much as 50%. I think the estimates range anywhere from about 20% to about 50% in this quarter alone. Now that's $1 trillion or $2 trillion in reduced spending. That's hard to recover from.
Is that, well, first of all, that is in the absence of the government stimulus, that's what would happen, or that's what they think will happen in spite of the government stimulus?
That's what they believe will happen in spite of the government stimulus.
And is that completely unprecedented in modern U.S. economic history, going back to the Great Depression, that sharp a fall off in GDP?
It's virtually without precedent. In the Great Depression, accumulatively from 1929 to 1933, there was about a 46% decline in spending. What these economists are saying is we're going to get a number that approaches that within a couple of months.
So you said the raw number is what? How much of a drop off in GDP?
Today or back then?
No, now that we can anticipate in the...
Well, the president of the St. Louis Fed estimated 50% in this quarter.
In this quarter, and yeah.
J.P. Morgan's economist, I believe, estimated 34% in this quarter.
And that is, now is that but isn't that about as much as the government is injecting in the near term in the economy in one sense? And I'm talking about the fiscal stimulus alone, like the 2.2 trillion, which was just supplemented like today or this week with another $500 billion. I mean, isn't that that comparable to the, well, you're saying even after that, they're estimating the,
it's hard to assess because timing matters immensely.
Yeah.
So if the government had $349 billion in small business loans, for example, which was meant to allow companies to continue to keep people on the payroll and thus continue spending, many of those checks still haven't gone out. Many of those applications have yet to be processed. So, it could lag several months. That matters in economics immensely.
Okay. And what is your assessment of the kind of bailout package we've seen so far? Like the initial 2.2 trillion, the new $500 billion. How well do you think that money is being spent? What would you change if you could?
I divide the effort into that made by the Federal Reserve and that made by Congress. The Federal Reserve is basically supporting existing debt in the marketplace. Liquidity is what folks refer to it as. I think the Fed has done a spectacular job. They have done more in a month or two than they did in a year to 2 years in the '08 crisis. It's as if the '08 crisis were a dress rehearsal for what they're doing now. They're not only doing more, but they're doing it more broadly, across more types of debt. It's municipal debt, commercial paper, corporate bonds, the full spectrum. So I'm pleasantly surprised and appreciative for what the Fed is doing. Congress is doing more than I would have expected. With a Republican-controlled Senate, I was skeptical about how much they could do and how quickly. They've done a lot. But even with what's being, rumored to be done, today and tomorrow, the finalization of this additional tranche of support, we probably have only done about half what needs to be done.
And what about the nature of the spending in terms, leaving aside the aggregate amount of the congressionally authorized spending? Is there any adjustment you would make in terms of how it's being distributed among small business, among individual households, and so on?
Well, it's weighted less towards household than I would wish. If I had a magic wand, I would have allocated more of it directly to households. I think that a one-time check to households isn't nearly as powerful as a sustained level of support to household. A monthly check. There's a number of countries in Europe that are actually stepping in and picking up the payroll of the companies in those countries. That is a much better approach, in my view. Monthly checks would be better. A one-time check of $1,200, it's welcome, it's not enough.
Of course, one thing about that, even the $1,200, a lot of it goes to people who don't particularly need it, right? As I understand it, there was a little bit of so-called means testing in the sense that there was a limit on how high your income could be if you were going to get that, but it was very high. Last I heard, it was like $100,000 for individuals and $200,000 for a couple, right? Your income had to be that high for you to not get the $1,200, whereas your average couple that made $180,000 last year, they're not tremendously needy, right? And whereas there are other needier people who only got $1,200 and could have used the extra money. Is that wrong?
You're right. There are any number of issues around the subject of fairness. You and I could pick this program apart with justification all day long, and we'll continue to be able to do that. But the issue of time matters immensely. Every day and week and month that goes by that spending is depressed, as it is right now, businesses get damaged irreparably, and it makes the path back that much harder. So, if I were going to make a trade-off between speed and fairness, I would pick speed.
And you would be spending, at least twice as much as Congress is spending now?
Who knows what the exact number is, but my rough sense of it, spending, I spend a lot of time in these numbers, is we're about $1 trillion or $2 trillion short still. And a lot of that right now is support that's going to be needed for the states and municipal governments. There's going to be a crisis in supporting education, healthcare, and payroll itself in states and cities very quickly. Now, it's rumored that there's going to be $500 billion. Congress is going to pass a bill for $500 billion to support states and cities. That number is going to be welcome. It's probably not sufficient.
Okay. And of course, states and cities, unlike the federal government, they can't just print money, right? There are various constraints they face. I mean, they can issue debt, although I gather some states are prohibited by their own constitutions from not balancing the budget each year, as I understand it. But anyway, it's the states and municipalities are in a much tighter fix than the federal government is in principle, right?
Without question. Not just in principle, in reality. So, the only entity that can create new money is the federal government in this scenario.
So
sorry.
No, go ahead.
States and cities are hamstrung.
So, I mean, just take the example that's most conspicuous to me, because I live, within commuting distance of New York. I was there, a month ago, I guess. And the subways there, I mean, massive revenue shortfall now because so few people are riding them. And yet, if they cut back commensurately on the number of trains to save money, that's bad as a public health matter, because you'd actually like the density of passengers on each subway car to drop right now. And that's a hugely expensive system. They take in an amazing amount of revenue, in good times and still have trouble, balancing the books. And that's just one example of, and I haven't heard anybody talking about what the federal government needs to do to step in for local public transportation. But I would assume this is a problem in lots of places. It's just one small problem, right?
It's a great example, and it characterizes really the entire system. And, all of these states and local governments are facing decisions in the immediate future on what to keep open, how to shut down, how to reopen, and funding is going to be required for all of that. And the scale of the shortfall in budget, as I understand it, is unprecedented already and could get a lot worse.
And then to, I guess, further compound things, when they open up, quote, open up the economy, which some states are starting to do, almost even as we speak. I think Georgia is starting to do some of that, notwithstanding resistance from some, urban mayors. You may see a little bit of a burst of pent up demand. Maybe there will be people who had been put off buying a car for the last 6 weeks, and they're going to go and do that. But by and large, do you agree that we will not see, once any pent up demand is unleashed, we will not see anything like a return to full economic activity, right? Because there are going to be a lot of people who still don't feel comfortable going to a restaurant and so on and so on.
Well, that's absolutely true. But what is also true is the governments aren't going to let them go back to, full participation in the economy right away. Mm-hmm. The plans that are being put together are staged plans. There'll still be all sorts of limitations on, people will be wearing masks. Employers will be asked to monitor things, take employees' temperatures. There'll be spacing requirements. So, it's really impossible for the economy to snap fully back anytime soon.
Mm-hmm. And, it's a global problem. For just the last, before we get into the analysis of what, and tap into your particular expertise, more specifically, it's a global thing. Just one more ray of doom I want to shed on this is like, right? I mean, we just haven't seen anything like this.
Well, it's interesting. It's going to be important and fascinating to look at how different countries fared. China, as you pointed in your introductory comments, China is almost, they may not be all the way back. They may not be all the way back for a long time, but they're a long way back already. I know a number of companies that depend on China for manufactured components. China got a week and a half behind, but is current now with those particular companies. That may not be representative of the whole country, but it's indicative of how quickly things were restored there. The number of deaths and the number of cases, even if there's some underreporting going on, looks to be orders of magnitude less than the United States. So, what did they do differently? We may find there are any number of differences, including differences in biological makeup of folks. There's a theory right now that Italians or Mediterranean folks are missing an enzyme that makes them particularly susceptible. So we may find differences like that, but we are also going to find differences in how governments manage the process. And if you just look at the surface evidence at the moment, China seems to have had less damage and be getting back more quickly. Sweden's going to be fascinating to watch. As you know, they didn't have the level of lockdown that other countries had. They have a little bit more in the number of cases compared to their Scandinavian peers, but on a per capita basis, they don't look like they're worse than the United States. So, there's going to be enormous lessons learned that are going to be critical to learn, for the presumed next pandemic some number of years in the future.
Mm-hmm. And there are people who would say that China had an advantage, maybe both in terms of the system of governance, authoritarian, and culturally, in terms of the whole tradition of, for example, these face masks are more common in East Asia, have been for a long time, and just in the normative tradition of compliance with communal kind of, imperatives. There are people who think maybe our culture just isn't well suited to really everybody getting on board in a time like this. I don't know.
That may very well be the case.
So, let's get into, one constraint on government spending right now is concern that there is such a thing as too much government spending, that you shouldn't casually incur a huge deficit. Now, as you said, there's two different kinds of things going on. There is, the fiscal stimulus from Congress, which is deficit spending that ultimately involves incurring debt, right? And then there is the monetary side of just injecting money into the system, which also, as I understand it, always, traditionally at least, entails the incurring of debt. Maybe we should put that discussion off, because I know you have some kind of innovative, you have some of your own ideas about to what extent you can get around some of the traditional roadblocks on the monetary side. But is it true, broadly speaking, to say that, look, whether it's fiscal spending or monetary support, the government is always incurring more debt?
Well, that's been the case. It's been the case for a while now. So, I'm going to make two separations here. The first separation I'm going to make is between what the Federal Reserve is doing and what Congress is doing. And the Federal Reserve is supporting existing debt and expects to be repaid in many cases very quickly being months or, no more than a year or two, for all the money that it's extending. So that's debt support. That's not net new spending in the economy.
It is taking over debt that already existed and saying we are now ultimately responsible.
That's right.
Okay.
And Congress is doing things that are spending, that gives you money that you can go spend at a restaurant. And they're two very different things. They're two important things, but they're two very different things. And it's really this latter thing, this supportive spending, that is the most directly responsible for the requirement that the government issue more Treasury securities to fund these things.
The congressional side. And the reason this distinction matters, well, to you especially, is because one theme in these two books of yours that we mentioned is that the thing to worry about, if you're asking, does economic doom lie ahead, is the total amount of debt in the private sector and the public sector. And you say that traditionally there's probably been too much emphasis on the public side, that is the government side of the debt, too much concern about that. Not that it doesn't matter, it's just that, relatively speaking, it has tended to be a smaller amount of money than private debt. What matters is aggregate. If societies incur more and more aggregate debt in the private sector plus the public sector, ultimately there is a reckoning, right? Is that a fair summary of your thesis?
Well, I would take it a step further, and I think that the difference between public debt and private debt is very important and profound. And frankly, I don't have much concern about the increased level of public debt that's being issued. And instead, I have a deep level of concern about the private debt out there. So if we can take those one at a time briefly.
So let me make sure I understand. You're saying that $1 of public debt is less dangerous long term than $1 of private debt?
By far, and in fact might not be dangerous at all.
Okay.
So the government can create its own additional money. So it can pay back debt that's issued with new money that it creates. So there's not much in the way of a practical constraint on the amount that it can do. The most recent number, the December 31st number in the United States, was government debt to GDP was 106%. In Japan, it's 238%. So I view that as kind of an illustration of the amount of headroom that we have in issuing additional government debt. Now, historically, over the last several decades, folks have believed that the consequence of issuing more government debt is inflation. That, there's still folks that think the amount of debt that we're issuing out of the Treasury is going to create inflation or hyperinflation or the like. We can't find examples of that when we study economies. We have a database of 47 countries. We have debt records going back decades, if not centuries. We can't find examples of where that's been an issue.
And when you say we, you mean the researchers who gathered the data that your books are based on. You're talking about your collected database.
That's right.
Uh-huh.
And instead, we have the opposite concern. We think that the more debt actually causes interest rates to go lower. We think there's a causal relationship between more government debt and lower interest rates. And we see that very clearly, frankly, since 1981. That was the point at which debt really began to explode in the United States and, frankly, in the world. And interest rates have been coming down for that entire 40-year period. Our expectation is that interest rates will continue to go further down as a result of the debt we're creating now.
Now, that is counter-conventional wisdom, right? Because I remember during the Clinton years, the argument for fiscal austerity, the argument for getting closer to balancing the budget and not spending, quote, irresponsibly, was that if the government didn't have to get into the debt market in a big way, that would keep interest rates down, right? I mean, the bond market was like the boogeyman that prevented federal spending. Is that right? So what you're saying is the opposite of the conventional wisdom? Am I right about that?
Yes.
Okay. Well, that would be nice. I'd love to believe that.
Well, if you just go chart, it's easy to do. You just go chart interest rates, whether they're long, short, or medium-term interest rates, from about 1981 to the present, and you graph debt to GDP, and you put those two things on the same graph, you'll see there's a virtually inverse relationship between the two. And that's not just true in the United States, that's true in Europe from, I believe, about the same time. It's true in Japan. It's true in China. Japan at 238% government debt to GDP has had interest rates of 0 for some time. Mm-hmm. So, you'd be really, really hard pressed to find examples of a sovereign country that issues its own currency and doesn't have a lot of debt denominated in a foreign currency, which is, a different problem that usually little countries have. You can't find counterfactual examples. So, and the debt that I just mentioned really constitutes about 70 or 80% of all the debt in the world. Mm-hmm. And there's been this pronounced inverse correlation.
Well, what you're saying is, I guess, roughly consistent with what we've seen so far in this crisis. Of course, there are a lot of things at play here, ranging from collapse for the demand of oil to God knows what. But the fact is, interest rates have dropped as the government has committed to incurring more and more debt. So we certainly haven't seen anything inconsistent with your perspective, right?
Yeah, and they're I would predict more of the same. I think negative.
Well, let's put my money where your mouth is. I'm trying to decide whether to refinance my mortgage. Would you recommend that I wait?
Well, I think rates are pretty low. In Denmark, mortgage rates briefly went negative.
Mm-hmm. That's what I want.
I'm not sure that we won't see more examples of that. So I wouldn't discourage you from refinancing, but I would suggest to you, even if you do refinance, in a couple of years, you're probably going to have another chance to refinance at even more advantageous rates.
So you don't think I should panic into doing it like today? I'll have time. I
think you'll have time. Now, okay. By the way, I would say to you that low interest rates are not without their own consequence. And the consequence, when we look across economies, is that low interest rates tend to exacerbate inequality.
And why is that?
Well, because low interest rates create these asset bubbles that we all talk about, rising real estate values, rising, over time. We were obviously...
Like 2008, there had been, these bubbles had been inflated through overly casual extension of mortgages and so on. And so that was an asset bubble that burst. Is that an example?
Yeah, there tends to be, an inverse correlation between interest rates and asset values. The lower interest rates are, the more support there is for stock market values and real estate values and the like. And it's the top 1% or the top 10% or what have you that tend to hold a disproportionate number of assets. So interest rates drive up the net worth. We got a special period now where all asset values are going to collapse for a while. But taken over the broad spectrum of multiple, years or decades, low interest rates tend to prop up asset values, and that tends to help the haves more than the have-nots.
Right, because the haves are more likely to have stock portfolios and so on. And then when the crash comes and the bailout comes, it is not infrequently the case that the haves get a disproportionate amount of the relief. Right?
Well, which is part of the criticism that's already occurring about the bailout packages that we've seen.
And you think there's at least some validity to that? I know you think speed is of the essence, but if you had time to really do it carefully, you think you would recalibrate in keeping with that critique?
Yeah, there's any number of things you would do differently if you had time, but I compare it to the quick preparations that were necessary in our major wars. There's countless examples of unfairness and fraud and wealth being created for the fortunate few. In World War I, World War II, the Civil War, you name it. That doesn't mean we shouldn't have ramped up quickly in each of those wars. Of course we should have, and of course we should now. That doesn't mean that the criticisms that we're seeing don't have merit.
Okay, so in terms of your somewhat maverick view that government spending and the attendant incurring of government debt is not going to increase interest rates, are more and more people seeing it your way? I mean, I knew maybe this is related to this thing called modern monetary theory, which also says you shouldn't. Well, that says you shouldn't worry so much about expanding the money supply, I guess, on the kind of monetary side, maybe to the extent that I understand it. But I guess two questions. First of all, are you seeing more people moving toward your point of view? And then secondly, what is this modern monetary theory thing?
So, yeah, there are a coterie of economists that are, you would call heterodox economists that, share many of the views that I hold. Many of those folks are folks I collaborate with. It's still outside the mainstream, but I think the present circumstances are causing a lot of folks to examine these theories a lot more closely. So I think the trend towards the view that I hold will continue to increase. Modern monetary theory, I almost view as a description rather than a theory. It's almost a technical description of how the United States Treasury and the Federal Reserve actually do work. So it is actually technically true that when the federal government incurs debt, that it creates an offsetting asset in the private sector, which is increased wealth. That's just a technical, you and I can go do the entries together. When the federal government spends, it ends up in the pockets of the private sector and ends up on the balance sheets of the private sector.
Now we're talking about the kind of congressionally authorized stimulus
that's right.
Yeah, the money has to go somewhere. Yeah,
and these guys, the modern monetary theorist guys, do a lot of really careful work, and they almost view the Fed and the Treasury as two sides to the same coin. That it's all part and parcel, because as you know, it's the central bank buys and sells government securities. That's kind of how money enters the system. The Treasury actually keeps its checking account at the Federal Reserve. So if you get a check from the Treasury, it's drawn on the Federal Reserve, and so forth and so on. So they view that operation all as the same thing, which is money creation, and they accurately describe the fact that spending at the government level creates private sector wealth.
So, when to just drill down on that on one part of what you said. So when the Fed quote creates money, they're actually acquiring debt, and so I guess there's a couple of ways they could, in principle, do it. I mean, they can in effect, they can assume responsibility for new Treasury bonds that are being created. That's one thing that can happen. Is that right so far?
Well, there's two things that I think about generally. One of them is the Treasury sells debt to a bank, because you know that's the way it works in the United States. Is a primary dealer bank would buy the debt, and the proceeds of that sale go into the Treasury's account at the Federal Reserve. So that's kind of what we think of most often as the creation of money. The other thing that happens is the Federal Reserve can inject more money into banks by buying the Treasury securities that those banks own and depositing the proceeds of that purchase into those banks' checking accounts at the Federal Reserve.
Okay.
So if the Robert Wright National Bank had $1 billion Treasury securities,
which we do, by the way,
and I bought those from you, I would deposit the proceeds into Robert Wright's account at the bank's account at the Federal Reserve, and all of a sudden Robert Wright has $1 billion in cash, if you will. And part of the theory is that Robert Wright's then supposed to use that to lend. That's
okay.
It doesn't really work that way, but that generally is the thought.
So one reason I ask is because I read somewhere that in this round of kind of monetary support, the Fed is acquiring corporate debt, including even junk bonds. Is that wrong? So that's kind of a separate type of activity, but they're doing that too. They're saying, okay, we will assume responsibility for this dubious loan that this company, this money that this company that's now on shaky ground borrowed, right?
The Federal Reserve historically has just bought treasuries from banks. In the great financial crisis, they extended that to buying mortgages.
In 2008?
Right. 2009, 2010, 2012. They bought mortgages. So they, I think, currently have about $1.4 trillion in mortgages on their books as of December 31st. So that was, a massive departure from prior practices. What they're doing now is, and that provides support for that debt, provides a buyer for that debt. It also provides, restores or maintains liquidity in the market. So what the Fed is doing now is that they've extended it beyond mortgages to commercial paper, to state and municipal securities, to corporate bonds. So it's really breathtaking, concerning to some, reassuring to others that they're coming in and doing this. But yes, all of a sudden, there's a lot more types of assets. Now, as it relates to highly leveraged debt, the junk bonds that you just mentioned, I don't know exactly what is occurring there. Part of what's occurring, I suspect, is that the government's making equity investment in those firms as well as supporting debt. But that's a little bit of what's not known at the moment, is exactly what the structure of those are. I will tell you that private debt in total is $32 trillion. probably higher than that now. And highly leveraged debt is only about $1 trillion out of that $32 trillion. You know, the mortgage market is $10 trillion. The commercial real estate market is $5 trillion, you know, et cetera, et cetera. So the so-called junk bond portion of that is really a small piece of the overall puzzle. But I don't know exactly what the structures are there, and that's part of what people are worried about and are suggesting might be lacking sufficient oversight, and things are being done there that, you know, smack of cronyism and what have you. I simply don't know. Everything that's being done there might be being handled perfectly. It might not be being handled perfectly. That's what we'll find out over time.
Okay. And though I'm sure you'd be against the cronyism, you are in principle among the less alarmed, I assume, because you think that moving private debt into the government's hands is a good thing and is less alarming than some people think.
It's a temporary thing, presumably, and it is less concerning to me, even though I understand there will be issues of fairness around debt that is not as creditworthy. You know, remember one of my statements was the Fed only does this when it expects to be repaid in a short period of time, which would, you know, certainly be true for most, you know, highly rated corporate bonds and state bonds and things like that. Once you get into highly leveraged debt, it's a totally different equation. I hope and expect that some of the structuring, you know, that it's taking the character more of like what was done for the automobile companies back in 2009 and 2010, that the government's making an investment on advantageous terms on behalf of the taxpayer.
Okay. Now, all of this recently led you to be involved in a kind of indirect exchange with a journalist, Matt Taibbi. This was, it took the form of an interview with you on the well-known blog Naked Capitalism. And it wasn't by Matt Taibbi, but it was, the interviewer directed the conversation, toward his concern. He's a very well-known, very good journalist, was at Rolling Stone. Now he's focusing on his newsletter, instead. But, he, and this is, it's kind of ironic because he is well to the left. I think he was probably a Bernie Sanders supporter, and yet he is concerned, about, I guess, the excessive incurring of debt by the government, which was traditionally more of a conservative concern. It was traditionally the left was saying, oh, loosen up, relax, we can afford it. And the right was saying, no, for whatever reason, he's concerned. And I got to say that's kind of my instinct too, just because I had always assumed there's got to be some limit. I mean, we can't do magic, right? We can't just, like to take the extreme case, I guess, you couldn't have a complete economic shutdown and just have the government keep issuing money forever, because ultimately the goods and services that we enjoy from an economy, the food on the table, the pumping of the gasoline for our cars, ultimately that depends on the goods and services that we ourselves provide in a certain sense, right? In other words, an economy consists of a bunch of people doing work and exchanging the fruits of that work with each other ultimately. And the work has to happen, right? I mean, in the long run, maybe you can get through a shutdown, but you can't. It just seems to me it would violate fundamental principles of the physical laws of the universe if you could do that like forever. And so there must be some limit on how much the government can do of its own accord. In any event, Matt Taibbi perhaps shares that intuition, or maybe he doesn't, but for whatever reason he's concerned. Does what I'm saying make sense to you, first of all, as like a baseline source of concern about some degree of government spending being ultimately coming back to haunt us? And then secondly, what do you want to say about this exchange you got into on Naked Capitalism?
So before I respond to that, I just want to make sure and note that we haven't yet discussed private debt,
right?
Which to me is the ultimate need of households and businesses to pay on that private debt, interest and principal repayment and the like.
Okay.
Which I view as one of the biggest issues of all as we think about the next several years. So, hopefully we can come back to that. I admire Matt Taibbi and his work. If I'm reading Matt correctly, I think his concern falls into two parts. One of those parts is the one you just articulated, which, isn't there a limit out there somewhere to what the government can do and what the Federal Reserve can do? Part of the criticism has been, the Federal Reserve was only $900 billion in size in 2007. It got up to close to $5 trillion in size and could conceivably be $10 trillion in size within the next year or two. So, I think there's part of Matt's comments, if I'm reading him correctly, have to do with that. And the other part of his comments, and I think really the part that he spends more time and energy thinking about is the potential for fraud and corruption and cronyism and the like. So I'm going to address those separately. I think his comments about the potential for abuse within this have all sorts of merit, and it's something that we should be examining today and tomorrow and the next day. And I think if there's any difference here, it's that I feel speed is of the essence. I continue to feel speed is of the essence. The new tranche of SBA loans, which are going to be about $320 billion, we need to deploy those quickly. It is hard for banks to deploy that money. There's the Main Street lending program, which is for the medium-sized businesses, I believe. And that's going to take even more work for banks to deploy. This is going to be hard work. It has to be done quickly. So, I'm in the camp that speed is the most important thing now, but I don't discount for a moment the concerns that Matt has expressed about potential abuse. Now, the separate issue, though, is how much debt can the government issue? How large can the Fed be? And I would agree that there has to be more thinking about what the limits are about this. And if you read the writings of Randall Wray, who has kind of written more than anyone else about this, he has the textbook on modern monetary theory. He points out these issues himself. He points out one of the issues, for example, is what does it do to the value of your currency on the open market in exchange for other currencies. So, in theory, issuing a lot of debt could mean that your exchange rate is adversely affected. So he doesn't disagree with any thinking, the need for more thinking around those areas. I agree with that too. All I'm saying is that limit is not within our immediate horizon. So, for example, the Federal Reserve, even at $5 trillion or $10 trillion, is going to be smaller as a percent of the United States GDP than the Bank of Japan already is to Japan's GDP. Mm-hmm. I would put it in context. The Fed is, let's call it $6 or $7 trillion right now. The total size of financial assets in the United States is about $110 trillion. So that kind of puts it in context. $7 trillion compared to a total financial assets of $110 trillion. We're not at a disproportionate size in the Fed. We could be over time. We're not today, and we're not in any foreseeable time frame. And I'll repeat what I said earlier. Our debt levels as of December 31st were 106% of GDP. Japan's at 238% of GDP and hasn't seen much, if anything, in the way of direct financial consequence for that. So we have capacity. Well, we have policy space, is I think what the economists say. We have policy space. We have the latitude to do several trillion more without pressing up against any concerning limits. And I think we need to.
Okay. So you said you alluded to private debt, but said we haven't really gotten into it as deeply as you'd like. What else do you want to say about that? I mean, again, you've got this whole database that you argue shows that, if you want to know when economic collapse lies ahead historically, you look at two things: the level of debt relative to GDP and the recent rate of increase in debt. The last 5 years of increase in debt. I think the index you use is combined public and private debt, but in any event, you think private debt is qualitatively a bigger problem. So I assume that as you look ahead, one thing you're concerned about now is the incurring of private debt by people who are in economic distress now, and you'd like to see the government do more to alleviate that and assume some of that burden, or is that wrong? In any event, say what you think needs to be said about private debt per se in this context.
Okay, so first and foremost, the expedient at the moment is getting cash in the hands of consumers and small businesses in any number of ways until we've stabilized things and restarted the economy. However, one of the things that was already true is that the private sector was lugging around a very high level of private debt already. So even before COVID-19, we were kind of towards the north end of what was a sustainable level of private debt. The more private debt you have, and private debt is your personal mortgage, it's the $100,000 loan your local restaurant has, it's all of those things added together. Private debt in 2000, I believe, was about 125% of GDP. Well, private debt as of December 31st was 150% of GDP. Private debt in 1950 was 50% of GDP. So in 1950, private debt levels were only 1/3 as much as they are today. So, and the more private debt you have, and I really do distinguish between private and government debt, because the government can print its own money, to use the phrase that's used. You and I can't print our own money, or we go to jail. So it's a different issue. Since private actors, people and businesses, can't print their own money, they have to pay back debt out of income. And the more debt they carry, the slower the economy goes. It becomes a drag or a burden on the economy. So we were already at a point where it was somewhat of a drag on the economy. I believe that's the reason that our recovery after 2008 was never as robust as economists kept hoping for, expecting. We were just carrying around too much private debt. So now we have a situation where a lot of folks are incurring more debt as an expedient to deal with this crisis, and their incomes are dropping. So you have a numerator effect and a denominator effect. And so, goodness knows what that 150 is going to turn into, that 150% private debt to GDP ratio is going to turn into. But I suspect it could get a lot higher over the next year or two, and we're going to have to deal with that. It's not something we need to deal with in April or May of this year. It'd be great if we could. I just don't think the political capacity is there. But over time, we're going to have to deal with it. Student debt is a huge problem in the United States. I've talked about this, but I've gone around the country and talked to folks about this, and it's shocking to me how many families are impacted by a burden. We need to provide some way I've posited that maybe community service, 10 years of community service gets you out of your student debt obligation. Bernie Sanders obviously has posited something more bold than that. One way or the other, for each type of debt, we're going to have to think about ways of creating relief.
Okay, now one way or another, we need to move the debt from the private sector to the public sector, to the government's books. Now, and you are less concerned than some people about the consequences again of large government debt, because as you say, the government can print money. Now, tell me, I know from past conversations with you that you have ideas about maybe changing, in a sense, the way the government prints money. I mean, correct me if I'm wrong, but traditionally, again, when the Fed injects money into the system, when there's monetary stimulus, the government is in one sense or another acquiring responsibility for debt, either treasury bills or private debt. And I think you think that that's not, strictly speaking, necessary. There's a way the government could create money without incurring debt. So A, am I right in characterizing your view that way? And B, is that related to your relative lack of concern about the incurring of government debt? In other words, you think that is going to be the escape hatch ultimately, this discovering that we can print money without incurring debt?
Well, and now you're talking about something that almost nobody talks about, discusses, or even thinks about. So I'm hesitant to even mention this, because to the extent somebody thinks that already that my theories are wrong, they're really going to have trouble with this one. But here's the truth. Almost all issuance of money involves the simultaneous creation of debt. So when the Treasury, when people talk about the Treasury printing money, or they use these terms and talk about creating money. In every situation, folks are talking about an identical amount of debt is created at the same time. And that's both when the Treasury issues debt and that's when banks make loans, which, as you know, banks making a loan is another form of money creation out of thin air. But when Richard Vague or Robert Wright goes and borrows $50,000 from the bank, there's a $50,000 loan created, and there's $50,000 deposit made into our checking account at the same time. Mm-hmm. It's a perfect illustration of what I'm talking about. Money is always created with debt and by debt. Not a lot of folks think about that. Not a lot of folks get into the accounting entries around that. It happens to be the case. So it begs the question, particularly at the Treasury level, is there a way to create money without simultaneously creating debt? And, a few of us have put forward ideas for consideration in this regard. You hear a bunch of folks, particularly in and around the MMT camp, who talk about the Treasury minting $1 trillion coin. I don't know if you've heard that. I hadn't
heard of that, but I'm willing to own one.
But at any rate, it's something on the right side of the Treasury's balance sheet that is not debt. And, we've seen examples of this in the past. In the America's Revolutionary War, there was money that was literally printed that wasn't correlated with
And what's
debt.
the means of getting it into the system? You just hand it to lucky passersby, or what?
No, it's a government spending.
I see. So it just goes to support the fiscal stimulus.
I mean, there's a lot of
you print the money to support.
There's a lot of very imprecise discussion around this. Once you kind of get anywhere near this discussion, folks start talking about helicopter money and all these things that are very loosely defined, and I think that's to the discredit of the idea. In this case, we're really talking about the Treasury getting a credit into their Fed account that isn't tied to debt. is that, it's almost tied to something, I call it common money, in a paper I've written. But at any rate, it allows government spending to occur without the creation of additional treasury securities.
Mm-hmm.
This is a discussion not too many people have, and it's a pretty technical discussion.
Now, there too, my reflex would be, okay, even supposing you're right, this is a viable thing to do, government creating money without debt. There must be some limit. It can't be like infinite magic, right? I mean, is my intuition correct there? It could come back to haunt you at some point.
In the case, I would argue that in the case of money that's created without debt, you do have a risk of inflation. So when I talk about doing that, and there may not be a single person in the world that agrees with me on this point, but in that case, you saw that in the American Revolution. You saw that in a couple other cases where. So I think if you did something like that, it would need to be very tightly circumscribed. There would be a certain amount of that you could do on a regular basis, but it would not be unlimited. It would be tightly defined. For example, no more than 2% of GDP per annum, mm-hmm. no more than 25% of GDP in cumulatively. So a lot more thinking needs to occur around that. But I tell you, with the amount of government debt that folks are starting to lug around, in the United States, aggregate debt, this gets back to what you were talking about earlier, aggregate debt to GDP, government debt and private sector debt, and you probably need to throw in state municipal debt, is 250, 260, 270% of GDP. That's double what it was a couple of generations ago. In Japan, it's 400%. So thinking about how you ultimately dispose that debt and what those limits are is an area of thinking that needs a lot more development. Not too many people think about it.
Okay. Now, if what you're facing is a deflationary abyss, which happens sometimes, and you're concerned about deflation, then the constraint on this approach you're talking about wouldn't be much of a concern, right? Because an inflationary effect is what you want. So at that point, in theory, if you could calibrate it correctly, you would say print lots of money.
I think that that's correct. And I think it's probably linear. I think that, you get X much inflation with this much of it and Y much inflation with, or 2X inflation with 2X printing of it.
Mm-hmm. Now, that leads us to the question of what should we worry more about at this particular juncture? Inflation or deflation? We're seeing a lot of deflationary effects. I mean, first of all, when there's a collapse of demand, that tends to be deflationary. You see that specifically in the oil markets right now. On the other hand, there are people, not you maybe, but there are people who think that the government stimulus will tend to have a countervailing inflationary effect. I guess I have two questions. A, what is the conventional mainstream thinking right now about the bigger problem? I assume that the bigger concern in general is about deflation, in which case your concern would be even deeper about deflation, but maybe a lot of people are concerned about inflation. I mean, look, in the past, in the way governments the aftermath of the Great Depression led to, along with other factors, to be sure, hyperinflation in some, right? I mean, Germany was suffering from hyperinflation at the time of the rise of the Nazi Party, I believe. In any event, that's been a problem periodically in various countries. So what, correct anything I've said that's wrong, and why don't you let me, and then let us know what is the conventional concern in terms of inflation versus deflation, and what is your concern?
So there's just been this perennial concern about inflation that you tend to read about regularly, no matter what. Inflation hasn't been a factor for 40 years in just about any developed country. The concern has been the opposite. The European Central Bank, the Fed, hoping to get up to 2% inflation.
Mm-hmm.
So I think the concern about inflation has abated, but it hadn't disappeared. I mean, you can't get away from, somebody writing about the specter or the boogeyman of inflation, somewhere at some point in time. I think right now, all of the concern should be about deflation. Inflation would be a nice problem to have at this point in time. Frankly, you're going to have a couple of disrupted supply issues in, the food chain that'll create a little bit of that. That'll be temporary. All of our concern ought to be about deflation at this point in time. And by the way, just for clarity, Germany's bout with hyperinflation occurred kind of in 1922-ish, way before the Great Depression. It related to having to pay debt in a foreign currency, which, by the way, I think all countries of all sizes should work hard to avoid having their debt denominated in another currency. It kind of always ends up getting folks into trouble. It certainly did for those folks at that point in time. But Germany's problems were deflation as well by the time you got to the 1930s.
Oh, I see. And the inflation had to do partly with the reparations imposed on, the debt they were paying had to do with the reparations imposed after World War I?
That was a big part of it.
Okay. So, and of course if there's deflation, that hurts different people, differently. People who owe money are then in trouble, right? If you've got a fixed mortgage payment, inflation helps you because relatively speaking, the mortgage payment is less and less. But if there's deflation, you're screwed, which means that deflation is going to hurt a lot of common folk, you might say, even going fairly high up the income ladder, maybe, I don't know, but that just becomes a huge problem, right?
Yeah, it's really exactly the same thing that we were talking about just a moment ago, which is, I think of it as a denominator effect.
Mm-hmm.
Your debt stays the same and your income shrinks. And, it's tough. That's a tough equation. That's, expressed in economics is called the debt deflation theory.
Now, is the conventional view as well as yours right now that, deflation is probably more likely than inflation where we stand now?
It's not just the thinking, it's the reality. It's what's happening when we pick up the newspaper. It's oil at a negative price is an example of that.
Mm-hmm.
We're going to start seeing examples of that, across the board. It's not a theory at this moment in time. It's deflation is in large part a function of demand.
Mm-hmm.
Demand has collapsed because we're all indoors, watching Netflix.
But I assume there are people who, looking forward and anticipating the amount of government spending we're going to have to see in the U.S., Europe, and so on, they're saying, well, okay, but wait a second. And, because these are people who, more than you, think that deficit spending is inflationary, right? And so there must be people saying, okay, but wait a second, we still have to worry about inflation, and that should hold down our government spending right now. I guess what you're saying is, look, you personally, Richard Vague, believe that the deficit spending is less inflationary than people think, but B, even if it is highly inflationary, right now we should welcome the inflationary effect.
We sure should. Simplistically, if spending was at $22 trillion a year and is now collapsed to 18 trillion or 19 trillion or 20 trillion, we shouldn't even begin to worry about inflation until that government spending has fully filled that gap and gotten us back to 22 trillion. And unfortunately, I don't think that's going to happen. It'd be nice if it did. So I think any concern about it, I don't want to sound like a broken record, but it's misplaced concern at this moment.
So your view is, when people say, oh man, this 2.2 trillion, that was just the first. We're going to see installment after installment of this. You're like, bring it on. That's exactly what we need. The government should spend as carefully as it can, given the sense of immediacy, but it should spend pretty freely.
I think at least another trillion or two is in order. perhaps more than that. It's needed.
And then the rest will depend on what we see about the extent to which the economy revives of its own accord as lockdown eases, and whether lockdown can be eased enduringly without.
Yeah, I mean, a lot of it depends on the slope of the restoration. If we can only get out half as much as we were otherwise, if restaurants are such that they can only accommodate half as many tables, et cetera,
right.
That's a barrier to full restoration of spending. So, if that slope persists for a couple of years, that's very different than if it only persists for 6 months.
But the government should keep picking up the slack, in your view, regardless of how long.
I believe that, and I hope they will. I know that will continue to be politically difficult.
Okay. Well, thank you, Richard. Anything else you want to say that we haven't covered?
No, thank you for the opportunity. I always enjoy these, and best wishes to you. Stay safe and stay healthy.
Okay, let me mention your books again. A Brief History of Doom, 200 Years of Financial Crises. A lot of data there. And a lot of data in the next economic disaster as well, that's the earlier book, right, of the two?
It is.
And then Delancey Place is your newsletter. People should subscribe to that. And thanks so much for taking the time.
Thank you.